How we doing, guys? So as promised, here's the 1K Q&A special. And thank you guys for those that left some questions, and I appreciate those who are subscribed. It really tells me that the videos are helping, which is my main goal for the producing the videos. So thanks again. I appreciate the subs, and I'll keep producing as long as you guys keep enjoying the content. So let's dive right into the questions. And the first one is regarding SEC filings. So this subscriber asked, so how do you read SEC filings and determine if a company is, junk, or if it's a good company to short sell, based on their filings? And so to be honest with you, I don't personally get into SEC filings when I'm trading. Even though I'm a short bias trader, I do take many more short trades than long trades. I assume every small cap company is fundamentally garbage, basically. So, most of these small cap companies, they're low in cash, have like zero revenue, and they're just starving to raise capital like any chance they get, right? So I just make the assumption that most, if not all, small cap companies are garbage. Now, that being said, you can still look at the SEC filings, and the two main filings I look at is the 10K filing, which is their financials, and the S3 filing, which is their, when they want to file a prospectus for a public offering or raise, increase the amount of shares, they'll file in those S3 filings. So those two are the good ones to just quickly glance at, and they'll give you a pretty good idea at what this company's about and if they're just in it to raise capital. So, most of these small cap companies are just shells, right? They're just in it to raise some money, and the CEOs are taking their money, and it's not really a great fundamental company to be invested in the long term. And that's why they're so great for shorts, right? That's why we love to short sell small caps. Most traders do well at it because you got all these fundamentals working with you as a short seller. Whereas for the long bias trader, they have to be very specific and more kind of scalpy on small caps because they know the companies are trash. They just take advantage of the volatility when it's there and the momentum. Now, with all that being said, I have IMPP up here, and this is a recent one that they're a fundamentally trash company. As you can tell, look at this daily chart, right? So even though this company is trash, short sellers know they were probably short selling here, they're adding here, and then they're probably blowing out Friday and then today. So, what good does it do you as a short seller to know that this company is trash when clearly the price action is not reciprocating that, right? And this is why I always preach, price action is king, guys. You can look at the fundamentals, that's fine. It's okay. You can know the fundamentals, great. But, this company had warrants at $1.25. And if we look back here, that's where it was kind of struggling on this day, right? So they was probably exercising some of those warrants today on that day, and short sellers got confident, right? They were holding it. It was kind of fading down, held that $1 area into the close, and then look what they did the next day. Gapped it up. All those shorts now are underwater, and they're probably either adding to their positions or panicking out today. And then they gave them another confidence boost with this crack here. So now the shorts are close to break even. They're thinking, hey, this thing is probably, it's trash. It's probably they're going to do an offering overnight. And yet again, it holds and just takes shorts up again for another ride. So, a lot of these companies, they know that active traders, specifically short sellers, are looking at their fundamentals, and they actually take advantage of that. So it's not really an edge to know which companies have poor fundamentals and what are the filings. It really doesn't give you an edge, and that's why I don't personally look at SEC filings, because I focus mainly on the price action. If a company is trash, great. I don't really care. If the price action is showing me that it's holding trend, it's got the volume, I'm not going to be shorting it because I don't care how trash it is. It's clearly going the opposite direction, so I don't want to be fighting it. So Hope that answers your question, man. It's basically like it's okay to know the fundamentals. It's okay to just glance at them, but don't take them with a grain of salt, right? Just know them and be aware of them, but don't trade and make your plans based off those fundamentals. Because at the end of the day, every small cap company, almost all of them are basically fundamentally trash. So hope that helps. All right, next question. We have so so this one's regarding my trading style. So this question is asking. So I rely pretty heavily on tape reading, and can you talk about quantifying your edge using something that is based so much on feel? So basically, intuitive or discretionary trading. How do you quantify your edge like that? So that's a really good question. There is a bit of edge in tape reading, like I always say, and you don't want to just use tape reading alone to make your trade decisions. That's more of a scalper's kind of mentality, and that's more of a scalping style. But for me, what I like to do is I like to combine the tape reading with technical patterns on the chart, and that's when you get the most powerful, effective moves and better plays. So, for example, let's take a look at this EPAM today. So I traded this EPAM today. I missed this entire move to the downside. Let's get rid of some of these lines. So I missed this entire move to the downside, but I managed to get a trade in right around this level here. And if you look at the technicals on this technical analysis here, we can see this 250 zone is a clear support, and this thing just had a nice bounce, kind of a capitulation move to the downside, nice bounce, recovery. Longs thinking this is going to bounce, and then it kind of fails there, and then holds a lower high here, holds another lower high here, fails. So I was watching this 250 zone as a breakdown or a breakout trade to the downside, and these are some of my favorite trade patterns. So just because you're discretionary in your trading does not necessarily mean you're purely guessing. It's a discretionary trader, an intuitive trader, they're not much different than a systematic trader in a sense that we have patterns that we recognize, but they're all in our minds. We're not trading off data. We're not tracking data like as aggressively as some other traders do. And that's totally fine if you do that. That's great. You're probably going to have a higher win rate doing that, tracking all your data, and but you're also probably, the downside is you're also probably going to sit on your hands quite often, because you're looking at so many specific details to plot your entries and take trades. So the bonus and the benefit to being discretionary is you're going to get a lot more signals, because you're simply watching the price action and you're watching for patterns that you recognize over your years of trading. So for me, this pattern was very recognizable because I saw this bounce here, lower high, and then it's approaching this support level, and I know that if this support level breaks, I'm going to get some longs to sell their shares. They're going to be bailing at this support level. So I love these for short entries, because they're just confirming that the stock is continuing its downtrend, and it had a failed attempt to reclaim this trend and reverse trend. And those lower highs are telling me that this thing is starting to look weak, and sellers are starting to take control again. So that's when I'm focused on the price action, the tape, near my entry, and waiting for it to confirm. And then once I see those sellers coming in on the tape, that's when I attack, and I'll go short, joining the sellers. So, and then we see it had a very nice move to the downside, and basically tested its lows there, or broke its lows there. So, yeah, to answer your question, how do you quantify, discretionary trading? If you're an intuitive trader, feel-based trader, it's kind of more, it's hard to quantify it to other people. And this is why I find it's very hard to teach my style of trading to someone else. A good example here I'll bring up is, you got a famous trader on Twitter. Everybody knows him. His name's Madaz. The guy makes a ton of money. He's a really great trader, and he's more of a scalper, but he's what I would call a discretionary trader. But he's not gambling. He has a system, right? But if you try to teach that system and quantify it to others, they're most likely going to lose money because they don't have that confidence that he has through his experience over the years. And he knows what he's looking for in the market, but he trades more on a feel base because he knows when it's time to make a trade and when it's not. And it's, not necessarily pattern based. It might just be, his mind just recognizes a pattern and then he takes advantage of it. But to reciprocate that to his followers or to his subscribers that are trying to learn, it's very difficult, right? Because they can't quantify that, only he can. So many of his trades seem very risky to others, whereas for him, it's a totally normal trade. And, that's kind of where, that's kind of how it is, right? That's what being intuitive or discretionary is. It's very hard to teach others and to quantify your edge to others. But as long as it works for you, that's all that matters, right? As long as you don't plan on starting a chat room. I mean, I would not be selling a chat room subscription, trying to teach traders something that's not really quantifiable, right? That's where you need to have that, the data, data-backed setups and strategies to sell to traders. If you want to teach, that's when you want to be, very meticulous and data-driven with your edge. So you can show on paper, this is how my edge works. This is what you'll potentially make if you follow the rules over the long term. So over a series of trades. And this person also says, they often find themselves envious of other traders that rely on extremely objective measures like, statistics, indicators, like we just talked about. So those are the data-driven traders who strictly trade off a strict system. And, there's no reason to be envious. I mean, that's their style of trading and it works for them. And in fact, most traders I do recommend should stick to a systematic approach, a very, rules-based approach that, there's no thinking involved and no discretion involved. I truly believe that's where most traders should focus, especially if you're new. And then later down the road, maybe you can kind of like evolve into a discretionary trader based off your experience. But for the beginner traders, I really do recommend sticking to those really data backed setups and follow the most strict systematic approach possible, because that's what's going to help you avoid all the psychological errors that come with trading. Having a system there is going to make you much less likely to make errors versus discretionary trading, field-based trading. Because I can tell you from my experience, I still do make plenty of errors as a discretionary trader because it's field-based. I will make errors, and that's why I have a fairly low win rate, because many of the trades I take don't work, but I'm good at cutting the losses and managing my risk on them. So over the long run, I do make money based off my risk management. But can my win rate be better? Probably, sure. But that's what you give up when you're a discretionary trader. You give up that accuracy to allow yourself to be involved in more trades over the long run, and which for me, that works better. For another trader, they might want a higher win rate with lower trades, so less trades, and that's totally fine too. But I know for myself, sitting on my hands just doesn't work for me, and I'm not that kind of a patient person. I really like to take several trades and be quite active with my trading, and that's what works for me. So you got to find what works for you. Whether you're systematic, discretionary, that's something you will figure out on your own through trial and error. So hope that answers that question. So the next question we have is, do you use a separate scanner for each setup that you trade? This person says they're totally beginning at trading. They're totally beginners at trading. And they started by learning setups that are very specific and rarely happen. For example, the parabolic short. Due to the specificity of the setups, I have a very specific scanner for each individual setups. And at the moment, they feel that this way of learning is limiting their perspective and learning. For example, if my scanners don't produce, I'm blank for the day. I hear experienced traders talk about their macro feel about the market, and I am completely blind to that. Would highly appreciate your 2 cents. Thank you. Okay, so you're a beginner trader and you have one specific setup that you're focused on, the parabolic short. So, first of all, I don't see anything wrong with that. I think it's great to focus on a setup, but at the same time, I do feel like you mentioned you are limiting your learning because right off the bat, focusing on one setup, you have no idea what other setups you're going to be good at or bad at, right? If you're just focusing on that one parabolic short setup. So I always recommend when you're beginning, you're fresh, you're new to trading, try out as many different styles and strategies as you possibly can. And, preferably with paper trading or very little money so that so you don't lose money and you're able to trade when you find your edge. So, I suggest trying everything, try out large caps, try out, long patterns, try out, bull flags, try out bear flags, try out all these patterns, try small caps, short selling parabolics, whatever it is, try them all and see where you fit, see where your style is, because I can tell you, everyone's good at something and everyone's terrible at something else. So for example, for myself, I've tried to be a dip buyer and I just am not good at it, not because it doesn't work, but because I'm not comfortable with the fact that I'm buying a stock that is printing lower prices. I personally love to buy breakouts, and buying when the stock price is high, that indicates to me that it's going to go higher. Buying a stock that's going lower to me indicates I'm buying something that's going to go even lower. And that's just my belief system. That's just my, that's my style and my personality. So I do think you are limiting yourself by sticking to that one setup. And, I think if it's working for you right now, great, stick to it. I don't see a reason not to. But, I think you should branch out and try other things, maybe on paper trading. See maybe what else works for you, right? Maybe you are better at going long. Maybe you are better at short selling large caps. Maybe you like options better, options trading. A lot of small cap traders transition to options and find much better results because you get to trade large caps with a smaller account, and you basically get the same or greater percentage gains with options versus small caps. So many traders love to grow their small accounts through that. But again, options is of course it's risky, but then again, so are small caps. So there's no excuse there. I know a lot of traders say options are risky, but everything in trading is risky. So, you decide which risk you want to take. But yes, I recommend definitely trying out different stuff. Again, like use the paper trading, use a simulator maybe to start tracking other setups, other markets. So like the large cap space, and see how you do there. If it starts to make more sense to you, then maybe that's your specialty, and maybe that's your edge. So, because I remember when I first started, I was specifically focused on the micro time frames. So I was a scalper, as many of you know. I explained it in my YouTube video regarding my journey, and it was quite a transition to go from scalping to trend trading. So focusing on the bigger picture, the bigger time frames. And I still struggle with that to this day. I still struggle with the patience to hold on to winners. And it's not so much the patience to hold on to the winners. It's just the fact that, these macro trends take so long to produce results. Whereas when you're a scalper, you're trading that high volatility momentum. You're able to capture very large profits quickly due to the volatility. And that's what I prefer. And I still do prefer that to this day. But, the reality is we're not going to have that volatility every single day in the market. And, it comes and goes in waves. So you have to adapt, and you have to, some days you'll have to trend trade. Other days you'll have to be more scalpy. And that's, a lot of traders struggle with that adaptation, and they just don't know how to adapt to the current market. So, you can't just be a one trick pony and expect to see, good results all the time. You're going to have periods where if you're trading one setup, you're going to have dry periods, for maybe weeks, even potentially months. And you have to be okay with that. And if you're not okay with that, then you definitely need to branch out and start learning new setups to add to your playbook. And that's just what I recommend. So hope that answered that question. So let's get right into the next question. So, tips on blocking out noise from people that don't see the value in what you're doing as a trader and will only see value once you start making a bunch of money. Oh, so these are like basically the non-believers in you, and whether it's friends or family. Well, the most basic tip I can give you, man, is honestly, don't even talk about what you're doing. You don't have to share what you're doing with others. I remember I really never talked about what I was doing to to friends, and I'd mainly just tell my close family, so maybe my parents, and luckily they were very supportive of me. Um, Mainly because my mom was like already a risk taker kind of in life, so she was totally understanding of my trading, and she definitely supported it. So I was really lucky for that. But I didn't really tell many other people. So I mean that was a big help to me, because most people you tell that you're in trading, they're going to be like, oh, how much money did you lose, or how much money are you losing? Because I mean, I don't blame them. Let's face it. Like, the fact is, most people do lose money in the stock market, and it's not a made up thing. It's a very real fact. So the majority of people that you tell, in your circle, they're obviously, they don't mean to be negative, but they're obviously going to see that as kind of worrisome, because they don't want you to lose money, right? So don't take it as a negative, but also you don't have to be talking about it to people. Just focus on yourself, focus on your own trading and your own process. And another thing is, being on Twitter. Twitter alone can be negative. I find, especially when I was beginning as a trader and I was struggling with consistency. Seeing others succeed, it's great. I always like to see others succeed, but it's also kind of, it makes you feel like, when you're not consistent, it makes you feel kind of like, oh, I'm not there yet. It brings up a lot of negative emotions for some. So even staying off Twitter can help you, I think, just to focus on yourself and your own process. Um, but I think just surround yourself with like-minded people. There are people in Twitter and trading community that are great. They offer great wisdom, and they're very offer great positive reinforcement for newer traders. I mean, that's what I try to do for my Twitter, but I also try to be realistic with new people and new traders, and tell them how it is. I tell them what they need to hear, not what they want to hear. And what they need to hear is, what you need to hear is the reality. And I'd say 99% of people do not make consistent money, at least in terms of substantial income to live off of for day trading. So that's the reality. And if you accept those stats, then what is it that's going to put you in the 1%, right? And what that is, right? It's the dedication, the discipline, the mental aspect of trading. It's all important, and it's all necessary to become successful. But you have to have that extra little edge, over everybody else. And whether it's the psychological edge, which I believe it is, or your technical edge, that's what it takes to, see those results in the end when you become successful. So yeah, just don't tell anybody. Just kind of keep it to yourself. I mean, that's my best tip, I could say. And even when you do become successful and make a bunch of money, you don't have to go showing it off, man. I mean, you don't have to prove anything to anyone. I see a lot of people on Twitter doing that, and that's fine. They probably have insecurities. Maybe they want to feel like they're worthy, or whatever it is. And I never felt the need to show off my success, and most of my family don't even know how much money I make, and I want to keep it that way. That's why I don't share P&L on Twitter. It's just my personal income, and that's how it should be, in my opinion. I mean, if you want to go and share your P&L, that's totally fine. That's your choice, but it's really not going to do you much good. So just keep everything to yourself, in my opinion, and maybe have one or two people you talk to in your inner circle that understand you, and so you can have that kind of support when you're maybe struggling or not doing too well in the market, and they can be there for your positive reinforcement. So even like I can recommend seeing a counselor. Many counselors deal with other issues not related to performance, but you can just go to any counselor and just talk about your trading, and it's confidential. And they may not be experts in the field of trading, but they totally understand the emotions and the struggle involved with losing money or not making as much as you'd like, and they can definitely help you out and be that kind of positive reinforcement in your life to keep you on track. So hope that helps with that question. Next question is, okay, what is your process on taking borrows for hard to borrow locates? What percentage of total possible gains? So this is a great question. I answered it on Twitter a while ago. I have this rule. It's called the 10% rule. So I like to look at a stock. So for example, this EPAM, I mean, this was really cheap to borrow, but we'll just use this for example. So I like to look at a stock, and I want to look at my potential entry and what's my potential target. And then I look at the borrow cost and see whether my potential profit is at least 10 times the borrow cost. Now, in this case, this is not a small cap, so it's very easy to borrow, very cheap. It was like a fraction of a penny, I believe. But if you take a small cap like, say, IMPP, then this thing is going to probably be a little bit more pricey, maybe 5 cents or 10 cents. And so in the case, if this was 10 cents a share to borrow, I definitely would not trade it. And the reason is, look at the range, right? Do you think you're going to get $1 per share out of this? Probably not intraday. You're not going to probably get $1 a share when the biggest range it's had today was, 215 up to 280, that's pretty solid, but not enough for me to borrow shares. So, if the borrows in this case, I would pay for the borrows if they were maybe 4 to 5 cents a share. That way I know I can potentially make maybe 40 cents a share and make that 10x of my borrows. So yeah, it's a really simple answer for that question. I just look at the potential range of the stock, my potential profit, and I times it by 10. That's the minimum I want to be. I don't want to be paying more than 10% of my total gains on a ticker in borrow fees, right? And there's traders that will pay the price, and they'll pay like 50%, 60%, and I think that's just ridiculous. But they're paying the fee. So as long as people are paying the fee, these brokers are going to continually charge these ridiculous prices. And to be honest with you, I've had a really hard time locating shares on small caps because they're just like insane. Absolutely not worth it in many cases. But hey, it's your decision, right? You want to pay to play, that's your choice. So I don't shame anybody for paying those borrows. That's their choice. It's their money. So totally your call. But yeah, that's what I recommend. I personally use the 10% rule. So 10 times the potential profit in 10x the borrow fee. So hope that answered that question. Next question we have is what to look out for when shorting, the top do's and don'ts. All right, that's another good question. So short selling, to me, there's only two edges when it comes to short selling. So one of them is shorting into parabolic moves, which is basically a big extension. You can call this I guess this is kind of parabolic. This is not quite as parabolic as I'd like, but we can use this as an example. So you got IMPP, it ripped here from 250s all the way up to 280s. That's a pretty big move for this stock. So for me, an edge is shorting into these kind of areas where the stock has made an extended move without a significant pullback. That gives you an edge because you got a bunch of longs chasing it, and you also have a bunch of shorts that are probably getting stopped out into these levels. So what happens then is it kind of just exhausts itself, and that gives you an opportunity for a very nice correction. So it's basically a reversion trade, a reversion to a mean trade, and these are probably the most common short trades you'll see. You know, other Twitter traders, you'll see them shorting into these parabolics, these kind of squeezes, and all they're doing is they're taking advantage of the early shorts who are stopping out, and they're replacing them over here. They're replacing the emotional shorts, and then they're getting that nice pullback. So the top do's for short selling is, you know, always consider the risk reward. That's very key when you're short selling, because as you know, as a short seller, your losses can be infinite. It's not the same as going long, so it's much more risky. So always make sure the risk reward is definitely worth the entry. That way, even if you take the loss and it continues squeezing, you take your loss and it doesn't matter because the risk reward would have been well worth it. So I like to look at prior support levels to determine that. When you're short selling, it's a lot easier to like determine the targets, because as you can see, look at this, prior resistance level here became support, right? So that's an area you could have covered. If you shorted in the 275 area, let's say, you could have covered here at 240, say 240s, because you see that's a previous resistance level, which became support. And yeah, as we can see right now, this is holding kind of this consolidation zone is acting as support. So we know if this breaks down, it's probably going to head down to this next level, this support area, 220s, and then maybe potentially test the low of the day by the end, and maybe break it. But that's how I determine whether the shorts are worth taking, is definitely the risk reward for these parabolics. So, and another way to, you know, the other edge when you're shorting, the next best edge is, in my opinion, is shorting, like we have here, EPAM, shorting channel breaks. So like, you know, you have a stock that's holding a support resistance, kind of in a little channel or a little triangle. As we can see here, we can draw a little triangle, and I like to go short as the trend is breaking, as the channel is breaking. So these are kind of like wedges. Sometimes I call them wedges, triangles, and they're one of my favorite patterns for shorting because the stock is collecting a bunch of longs in this little channel, and you know, once it breaks out, whether it's to the upside or the downside, you know, you obviously don't want to be shorting when it breaks to the upside, but when it breaks to the downside like this, you get, look at this beautiful selling, just constant selling. And you know, they don't always work this well. This is a great example. It's probably like an A plus best case scenario example, but you know, that's the possibilities when you take these trades. So shorting these support breaks and then shorting the parabolics, those are my top two favorite setups in my personal playbook. And they work great. You know, if you stick to them, you're probably going to win more often than not. But those are the top do's, I'd say. And you know, of course, the main one is always manage your risk when shorting. And like the previous question, always, you know, pay the appropriate amount for borrow fees. Always consider the borrow fee before shorting. That's very important. It'll, you know, if you're just paying any fee, it's going to probably eat up at your overall profits. So you want to make sure the fee is worth the risk reward. You want to make sure the risk reward is big enough to cover that fee and at least 10x it, as we explained earlier. And that's just my opinion on those on borrows. So, and the top don'ts, you know, the biggest one I'd say is don't fight the trend. I mean, this is something a lot of shorts tend to do, including myself. I've done it in the past. You know, I had one of my worst days fighting the trend. I was just constantly shorting, cutting the loss, shorting, cutting the loss. I just took so many losses that day and just they add up so quickly. But the main thing is just don't short the trend. Don't fight the trend. If a stock is trending against you, I mean, why are you? What reason do you have to fight it? Is basically just your ego, right? So IMPP is a great example on the daily chart. Or if we look at a bigger time frame here, let's take a look at the 60-minute. Yeah, so you can see the stock is clearly trending on the bigger picture. So why are shorts fighting it? It's because they have such a micro time frame in their minds, and they're not willing to look at this as an objective, from an objective point of view. This is a clear uptrend, and like what reason do you have to short it besides your ego? It's probably just you wanting to be right on the stock, right? It's probably just you wanting to defeat the stock and conquer it and just be right and maybe you make your money back. Maybe you lost on it. So this is the number one killer for short sellers, is fighting the trend. I spoke earlier about shorting into parabolics, and that's a bit different because those are more shorter time frame trades. So you can take advantage of those as even as scalps. You don't have to hold the stock all day assuming it's going to fade. And I think this is where a lot of short sellers are going wrong in this market. You're not really getting those stocks that fade all day as we used to see. These small caps have a lot more juice in them, and they can hold on for several hours, several days, even like a week or so sometimes. So as you can see here, it's not that easy to catch an all-day fader these days. So you want to always respect the trend as a short seller. If you're fighting the trend, you're no longer trading objectively. You're trading emotionally, and that's just a fact. So as soon as you recognize that you're fighting the trend, that's when you should just step away from the screens, maybe shut it down and take a break, come back later. Otherwise, you're going to probably just keep fighting it and maybe take a huge loss or even blow your account. So I'd say that's the number one don't as a short seller. And another one is don't take trades that are not worth the juice. If the juice is not worth the squeeze, don't take the short. So this is where a lot of shorts go wrong. Maybe they have a system they think it's a good system. They think it works, and what I find is they're just shorting these stocks that are not worth shorting. They just don't have the range. Maybe they don't have the volatility, and they're just chopping themselves up on these tickers that just are not worth trading. So I mean, you need to first of all recognize your biggest edge as a short seller is range, is the volatility, is the range, it's the risk reward. That's your biggest edge. That's what's going to help you make money over the long run. So if you're trading a stock that's basically in a channel all day, or maybe it's it doesn't have much range, that's where you're going wrong. Unless you're trading massive amounts of shares and scalping it all day, then you're probably not going to make much money trading those kind of tickers. So always focus on stocks with range and decent volume. That's where you're going to get the best risk reward most of the time. So IMPP is pretty good, I'd say. It has pretty good range, really good liquidity. But at the same time, it's not going to give you those big home run trades when you're shorting it, because we're still holding a trend. It's still an uptrend. So you can take some great short trades on it, but you got to be proactive with your take profit orders. You got to take profit when it gives you them. And then you can always re-add and then, kind of scale back in, scale out, that kind of thing until the trend actually breaks. But, when the trend is still holding, assume it's going to hold until it doesn't, right? So that's the big don't. I mean, definitely don't focus on stocks with minimal range. You're just going to waste your mental capital, and all for maybe 10 cents a share in profits by the end of the day, or maybe even flat. So make sure the stocks have range. That's a big one, and that should help. All right, so next question. This one's a three-parter. So how do you decide which stocks to trade at the market open? How many hours a day do you spend looking at the charts? And are there specific setups that you prefer to trade? Uh, so those are all good questions. So for me, I just use the scanner. It's very simple. In the mornings, I'll just use my gap scanner, and I look for like the top gainers. And since I'm more of a short bias trader, the bigger the better the gainers, because the more likelihood they have and the more room they have to pull back. So I'll look at the scanner, and like today, for example, I really didn't like anything today. I mean, so for me personally, I don't like to trade stocks under $2. And the reason for that is they're not as volatile. They can still be, they're very tradable, but you have to take, in my experience, you have to take a massive amount of size to trade them to make them worthwhile. And I just don't like to do that, with the commissions and whatnot. They do add up. These are not my cup of tea, these kind of trades, although this was a great ticker. I mean, it ran 50%, or sorry, 80% to that 180 level. It's just not my cup of tea. So I'm probably not going to short this one, and just not my style. But I do look for stocks above $3, and another reason for that is it allows traders to use margin. So you're going to probably get more volatility and more volume and more moves with the margin, because you got traders with smaller accounts. They're able to trade those as well. So you get more rookie traders in them, and that gives you a better edge too if you're a professional trader, because the more dumb money involved, the easier it is for you to make money. So yeah, I look for stocks above $3 a share. I look for good range on the day. And how I determine range is, it's very simple. You can kind of just, I don't like to trade the market open. I like to wait for things to set up, and you kind of just watch the stock and see how it's kind of moving, and you can kind of gauge the potential range for the day based off, the action, the first 15, 30 minutes of the day. So that kind of gives you an edge, just knowing the range. And the next question is, how many hours a day do you spend looking at charts? To be honest with you, I do not look at charts. I'm not one of those traders that reviews charts, overnight, and prepares a watch list and all that stuff. I think that's great if you do. That's fine, but that's just not for me. That's not my style. I'll sometimes prepare charts. Maybe I'll look for about 30 minutes or so, just the night before, just skim through the charts. And I like to look at previous runners, so that, if let's say last week there was a few hot stocks, for example, IMPP, which we were just looking at, I know this stock is going to be on everyone's radar. So I'm definitely going to have it on my watch, simply because it was hot last week and it's still holding trend. So I know this is eventually going to fade and crack down and offer a really nice short trade. But I'll keep it on watch in the meantime until it's ready to have that big unwind day. So yeah, I don't even spend hours. I'll maybe spend 30 minutes. Maybe by the end of the week, I'll just kind of compile some charts that were in play and have them on watch for the following week. But as for intraday, I'll just look at charts that are moving, stocks with range, stocks with volume, and I'll decide which ones to trade based off my criteria. So above $3 a share, good range, cheap borrows, etc. So. And specific setups that I trade, I kind of went over them already, but the parabolic short is one of them. So if I were trading this today, which I decided not to trade, but if I were to trade it, I'd be kind of maybe watching like these areas, kind of these parabolic moves for some trades. So this first parabolic move, that would be maybe a possible entry for me, and then maybe just scalp it out, and then this parabolic move, and then this kind of double top area, I'd be kind of watching this for another entry. So yeah, the parabolics are probably my favorite, because they offer great risk reward. And then my other favorite, as we discussed earlier, was the channel break, or the wedge break pattern. So this one's one of my favorites as well. To the long side is also great if it sets up. But if I'm going long on these patterns, I prefer this stock to be, I don't want it to be under all these support levels. I prefer it if it was up here, somewhere up here, setting up, so I know that shorts are underwater, and the likelihood of it following through to the upside is much greater when it's not trading under all these levels, right? Because you got a bunch of longs here now underwater. You don't want to be taking long setups that are under VWAP and like very, very weak charts, very weak looking charts. I definitely would not be buying this if it were breaking out, but it's a great short trade because you already have all these shorts, or sorry, all these longs underwater. So you got that great continuation. And this thing, it worked a lot better than expected because I think they have a catalyst to do with Russia, what's going on in Russia right now and Ukraine. Um, so yeah, that's definitely triggered a lot of panic on this today. So news definitely helps fuel the move. The catalyst is I don't pay too much attention to catalysts, to be honest, when I'm watching the gap scanner, but they can absolutely have a significant impact on price action. And as you can see here, this panic was all from the negative catalyst to do with the war going on right now. So you can take advantage of these catalysts if you're prepared. But I was not watching this at the time, and I don't think there's any way I would have caught this move. But it's good to have the down gappers on the biggest percentage of losers on your scans too, because you can catch some really nice short trades sometimes, like this one. But this was probably not on anyone's radar today because most people focus on the gap up scanner, because most traders are bullish, right? Most traders go long. I'd say like 90% of traders are bullish, and it's a very small minority that are short sellers. So yeah, those are my two favorite setups, definitely. And as I was saying for the longs are kind of the same, I would say, but inverted. So you just invert like say the parabolic short for the long side would be a downside move. So basically like a panic to the downside when you got a bunch of longs selling. So I mean, this one's a good example here, but I don't think I would have traded this one. It's just a bit too risky with the negative catalyst. But this is an example of like a panic, parabolic to the downside, right? So you got this really, really extended move, and then it starts to get quicker, bigger moves, and then you see this volume, kind of massive volume surge. That's the capitulation move, where most of the longs get out, and usually there's a reversal that follows. So this kind of had a nice little reversal. So rent bottomed from 225 up to almost 270. So very nice bounce if you could catch that. So these moves, I like these ones, but they definitely don't show up very often, very rare. So you have to have other long setups in your playbook, and that's why I like just simple breakouts. So simple wedge breaks, the upside, bull flags, anything kind of like that. And I'm not really a dip buyer, so I don't like to buy the dips that much, anticipating a breakout. I'd rather just wait for the breakout and hit it once it's confirming my thesis. So yeah, those are definitely my favorite setups to look for. And I'd say I recommend just keeping it simple if you're trying to like find your playbook in the market and your setup. Just try to keep it as simple as possible. I mean, it's not rocket science. I mean, trading is quite simple. The actual process of trading is pretty simple if you think about it. And if you're just looking at it from an objective point of view, with no capital at risk, just look at the charts and you'll start to see patterns set up over and over and over again. The problem is most traders they're not able to execute that when real capital is at risk because their emotions come in and sabotage them. So, that's why you always have to start small when you're beginning, risk very tiny capital that you're comfortable with losing so you can get familiar with the patterns you're trading. And once you see that consistency in your bankroll slowly building up, then you can get the confidence to start sizing into those setups and slowly building building up your risk tolerance over time. And that's essentially what I did. That's what every trader does to, get to the level where, you're making significant amounts of money. You're just basically taking the same setups that you were when you were risking $50 of capital or $100 of capital. You're just, multiplying that and compounding it over time, doing the same thing. Um, so another thing for my setups though is the liquidity is, it's pretty important, but at this stage in my trading, I don't really care much about having the best liquidity. I've sized down quite a bit during this market. And that's simply because the volume's not nearly as what it used to be, right? In the pandemic era, we had like 10 times or 20 times the volume. The amount of traders that were coming into the market was just insane. And you could afford to take, hundreds of thousands of shares if you had the bankroll to. Now, if you try that, you're gonna move the stock price if you try that. So it's not definitely doesn't work now. So you have to adapt in terms of position sizing when trading your strategies, because the market's always changing, right? So you can't always be taking X amount of shares on any given stock. You have to base it or gauge it based off the liquidity, and then make your decision on what's the most amount of shares I can take on this stock, on this setup, without affecting the price too much or without affecting it at all. And that's what it comes down to when the volume's kind of drying up like this. That's what you have to kind of decide. So I've seen a lot of traders struggle with the position sizing. They're so used to just swinging for the fences in the pandemic market, and they're still trying it, and maybe it works some days, but most of the time it doesn't, right? Because the liquidity is not there. So if you get stuck in a losing position, you can't even take your loss, and I've been there, and believe me, you don't want to be there. So I'd much rather just size down and be able to cut my losses as quickly as possible without influencing the price of the stock too much. So yeah, those are my setups. That's what I look for. Next question: what is your hotkey setup? All right, so for hotkeys, I only use hotkeys for take profit orders. So I don't use hotkeys for entering positions. I always do that manually, whether it's with a market order or a limit order. And I usually, so for long positions, I usually have 4 hotkeys for exiting trades. So my F5 is to exit 1/4 of my position on the offer. My F6 is to exit half my position on the offer. F7 is to exit 100% of my position on the offer. And my F8 is my bailout key. So that's where I want to exit my entire position, just market order out. It'll hit the bid or market order out. And that gets me out of my position completely. That's in case the trade goes against me. So I want to get out right away. Boom, F8, I'm out. And for my short positions, I use my control key, plus I'll use my control plus Z is to exit 1/4 of my position on the offer. So cover 1/4 on the offer. My control X is to exit my entire position on the offer. So that's my bailout key for, say I'm short a position, I want to get all out. I just want to get out, it's squeezing on me. I'll just control X, boom, I'm all out. And then my control plus A is these are exiting on the bid. So these are exiting on the bid orders. So my control plus A is to exit 1/4 on the bid, on the current bid. So adding liquidity. My control plus S is to exit half the position on the bid. And then my control plus D is to simply exit the remainder or 100% of my position on the bid. So those are the orders I use most of the time, because I'm exiting when I'm exiting to take profits. I'm adding liquidity. So I'm being on the bid as a short seller. You're adding liquidity. But I definitely think it's important to have if you don't have those hotkeys, you definitely want to have one for exiting, taking liquidity and exiting immediately, whether you're long or short. So for me, those keys I just explained. So I hope that helps. And the next question is small caps versus large caps. So I'm not sure what this question is asking. Small caps versus large caps in terms of which is better to trade or how they trade differently. I think we'll say, how do they trade differently? So small caps, I would say small caps are very much more emotional based, so more retail traders involved. But lately, we've had a lot of manipulation and big money involved in small caps, so it's not quite the same as it used to be. But generally speaking, there is more retail money in small caps, so less HFTs, less algos. So what that means is you get some predictable price action, um, and it's repeatable. So like we were talking about the parabolic moves, um, that's shorts getting squeezed out, the early shorts. So that's retail emotion, right? They're driving the price up and squeezing out all the retail shorts where they're emotional, and then they're selling, right? So there's a lot of emotional moves you can take advantage of in small caps. That's one of the reasons I focus on the price action. But when I trade large caps, it's a little bit different, because there's a lot less emotion involved. It's large caps tend to respect technical analysis better, in my experience. So when a large cap is trading, um, I like to focus on technicals mostly. So if you try to read the tape on Tesla, you're gonna have a migraine because it's not very easy to read, and it can be very unpredictable. It can do make moves that are very unpredictable, and this is where the technicals and the bigger time frames apply to large caps. So you always want to be focused on the bigger picture on these. Where are the support levels? Where are the bigger picture levels that I want to be watching? And as we can see on Tesla, uh, had a really big it's kind of following the SPY. This follows the SPY very well. But yeah, it's a great trader. It's an absolutely beastly ticker for day traders because the range is excellent, most of the time. The problem is getting on the right side of it, right? So when you have an established trend, you want to join it, and then when you see the trend going the other way, you want to join it as well. So I don't like mean reversion trades on large caps. Me personally, I follow the trend when I'm trading large caps. So for example, Tesla, if I was trying to short this morning, this whole move, trying to guess the top and assuming it's going to pull back, well, you're basically guessing, you're betting against the market, right? Because the market had a nice rally in the morning. Tesla's kind of doing its own thing today, though. It's relatively strong, but yeah, I prefer to when it comes to large caps, I focus on the trend and joining it, and then large caps, I prefer more mean reversion trades. So I definitely don't like to join the trend on small caps because I don't trust them as much as large caps because they can crack trend at any time. Whereas a large cap, it'll give you some time to think about it, think about your trade before you exit. This one will just break down and just it's just more choppy when you trade the small caps. They're kind of choppy, so they tend to respect the trend for a while and then they'll break down and they'll break back up. So again, I like to just look at the bigger picture on the larger caps and just see what's going on there. So Tesla's kind of just, so we can see it's kind of just holding this EMA, this bigger time frame, and the kind of VWAP area. So yeah, that's my. I don't think any one of them is better than the other to trade. I don't think small caps are better than large caps. I think both are great to trade, but you do have to trade them differently. And keep in mind that if you're a small cap trader and you're taking your strategy into large caps, it's probably not going to work. Because small cap trading is heavily reliant on tape reading, price action, and emotional moves. Whereas large caps, there's mostly HFTs trading this thing. There's barely any retail traders, so it's going to make more irrational moves, and it'll go a lot higher than you think, and then they can go a lot lower than you think. If there's like HFTs hit their buy programs on, you're going to get squeezed if you're trying to short against the trend. If they hit their sell programs, you want to join the trend, sell with them. So always be with the HFTs, always be with the trend. Just respect the trend on large caps is my biggest tip. And don't be a mean reversion trader on the large caps, unless there's a significant level on the bigger charts, on the daily chart that it's running into maybe. Then that's when I like to short or try for a mean reversion trade, or like a dip buy, for example. So Tesla right now is running into, this prior consolidation is probably going to have some trouble in this 900 area if it gets there, or this, the high 800s. And as we can see already, it had trouble in the high 800s there. So some supply over here, some longs probably selling once it gave them their break even. So we'll see what happens there, but yeah, that's my advice for those. So all right, I think we're all done with the questions. So that's about it for the Q&A, guys. Appreciate the questions. Some really good questions there. Thanks for dropping them. And if you do have any other questions, you can leave them down below. I'll try to answer them in the comments. But I think we covered basically all the questions for today. Oh, sorry, there's actually one more question, and this one is this is a very good question as well. So I guess we saved the best for last. So can you talk about the transition of becoming a consistently profitable trader after years of being flat or losing? How long does it take to feel comfortable that you truly made the turn and are not just having a good run? All right, so great question. I think every trader asks themselves this. At the end of the day, it's pretty difficult to tell whether you've made the turn, whether it's a permanent change in your trading and you're really made the positive turn to profitable. Because let's be real, with trading, you can lose all your money in a single day. No matter how disciplined you are, no matter how long you've been trading, there's always that possibility that you can throw it all away in one bad trade or one bad day. And this is where trading is, it can be kind of a scary job, because if you don't have risk management or you don't have that discipline to control your over trading or your impulsive trading, you can have some pretty bad days and give back a lot of your profits. But I think for myself, like what really solidified the turn was putting together consistent green months back to back. So once you start having green months, like significant green months, enough to pay yourself and wire out each month, I think that's when you can safely assume that you kind of have a hang on it, and you know what you're doing, and you have a pretty good hang on your control and your discipline. But the thing is, that can change at any day, right? So you can be disciplined for a year straight, and then the next year you can just, who knows, you can just throw all that discipline out the window, and maybe some personal stuff's going on in your life that's affecting your trader psychology, and you just start losing when you've been a consistent winner for over a year, and then you just start throwing it away. So like things like that can happen, and that's why I always tend to over exaggerate the importance of your trader psychology. So your mindset. Are you in the right mindset to trade today? You have to ask yourself that every single day. What mindset or what mind frame am I in today? Am I thinking about profits, or am I thinking about my process and executing well? And I can tell you, for most traders, it's the former. They're just thinking about their profits. They want to make money today, and that might work in the short term, but if you keep that mentality, you're going to lose over the long run. So for me, the big shift was not necessarily in my trading results, but the trading results were just a result of the shift in my mentality. So I can tell you from my experience, anytime I enter the market with, and I still do this today, I'll still have days where I do this. Anytime I enter the market with the idea of, I want to make money today, or I want to have a big day, or, I've been having, I had a consistent week, let's keep it going, I want to make more money. I can tell you almost probably 9 out of 10 times, or even 10 out of 10 times, I'll lose money that day. And it'll be a pretty decent loss because I'm trying to force out the outcome in the market. And I think that's the biggest change you have to make to make the leap to profitable. That's the thing where I'd say 99% of traders will not be able to do. That's why, that is why most traders fail. It's not because it's hard to, understand chart patterns. Everybody knows how to win, right? Nobody has trouble making money in the market. It's not that difficult to put on a winning trade or 2 winning trades or 3 winning trades. What's difficult is controlling your emotions and your actions when you are wrong. When a ticker comes along and doesn't respect your thesis, and it just goes against everything your system tells you, and it's just completely going the opposite way and just fighting you, then those are the days that are going to determine if you can do this for a living over the long run, because those are the losing days is what really separates the professionals from the amateurs, right? So amateurs tend to have much bigger losing days than their winning days, and then the pros have much bigger winning days than their losing days. And the pros still have big losing days occasionally, but it's not once a week or once every month. It's like once every several months maybe they'll take that outlier loss, but they can handle it because they have that cushion, that built up profit cushion. So it's not a big deal to them, and then they just get back right into the mindset of process, and then they recover that loss within a few days. So yeah, the number one thing to make the shift, I've talked about this many times on my channel, and I still believe it to this day. It's all about your mentality, man. You just got to have that mentality of process over profits. And if you're seeing inconsistent or losing results or flat, it's probably a psychological thing, but you also want to look into your technical edge, because that could be the problem too. You never know if it's just psychology or your technical edge until you actually look at your trading stats. Use something like TraderView, review your stats, really see where you're going wrong. Are you having blow up days that are wiping out your days or weeks of profits? Are you taking one bad loss that wipes out like an entire month of profit? Or are you that trader that just revenge trades and over trades and just takes a bunch of paper cuts? You got to find out what the problem is for you and why you're not making money. Because if you don't know why you're losing money, it's going to be impossible to make the turn into a profitable trader, right? So for me in the beginning, I was losing initially because I was taking big losses. I would totally have zero risk management, let trades go against me and like blow my small account at the time, and I had no risk management. So I learned my lesson from that, and I became really good at managing risk after that. But then my problem became over trading. So a bunch of small losses, adding up, and they would lead to a big red day for me as well. So, now my main concern is over trading. So I have to manage that daily. I have to constantly be disciplined enough to manage it. Otherwise, I know that if I don't manage it, I probably would not be profitable right now. So I would probably still be losing money. So you need to find your problem, what's really holding you back from consistency. And I can tell you, if you're not seeing profits, that at the end of the day, it's because you're having your losers or your losing days are bigger than your winning days. And there's only 2 reasons why that's happening. It's either you're taking one bad trade and you're not respecting your stop, and it just takes a huge chunk of your capital, or you're over trading. You're revenge trading, you're emotional, you take a few losses at the open and you want to make it back, and then leads to a huge red day, right? So, I highly suggest implementing a max daily loss, at least to minimize those days. So when you do trade, emotionally, you can have a max loss there to minimize it. Maybe like 5% of your equity or something like that. Whatever you risk per trade, just times that by 5. So if you risk 1% of your capital per trade, set a 5% daily max loss, right? So if you take 5 losses in a row, you're done. Because if you take 5 losses and you're down 5%, if you don't have that stop loss to make to stop you from trading, you're probably going to try to fight and make it back. I know, at least I know I used to do that. So, and I still sometimes do it to this day, but it's a really bad habit, and it will cause you to be a consistent loser in the long run. So highly suggest you focus on what the main issue is, and implement some things to start really making the change, if you want to see that consistency over the long run. So that's the last question for the day, guys. Once again, thanks for sending them in. Great questions. And thank you for those that are subscribed. I do appreciate it. It really shows me that you guys are seeing value in the content, which is great. So until next time, we'll see you in the next recap. Probably going to upload one this week, and hope you guys enjoy it. All right, guys. Thanks again. Cheers.